Hi, team. Accounting is fun, and it's even more fun when we're playing with adjusting entries. We're in a busy series where we're making adjustments to the trial balance. And we're not actually yet making the adjustments. We're just doing the background work to get to be able to make the adjustments. So the journey continues. So we know that the accrual method of accounting requires adjusting entries. We're at the stage where we're getting close to posting adjusting entries, but we're still making the adjustments in the moment. We know that these adjusting entries are accounting entries, journal entries that are used to reconcile transactions that span through different accounting periods. It could be an end of a month that starts into the next month, and there's a transaction that spans that period, or it could be the end of a quarter, a 3-month period where a transaction actually crosses over, or the end of a fiscal year, as an example. So we know that we need to make these adjustments, just like adjusting a tie. The tie is already on, the journal entries have already been made, but now we need to adjust the journal entries. We need to adjust the tie. We know that there's general categories of adjusting entries. And again, this video is one of several in this series. This is really quite a busy series. So watching all of these videos at least once, most likely multiple times, we hope you get to this stage. But for a quick recap, we know that adjusting entry categories include expenses like prepaid expenses or accrued expenses. Prepaid expenses, we pay up front, and we need to accommodate that adjustment and make those adjustments as we move forward through continued periods. Accrued expenses, meaning we've accrued some expenses, but we haven't yet made any payments on those. Or revenues, unearned revenue, where somebody like a client pays us maybe cash in advance for a future catering gig where they paid us the money, we owe them the labor and the food. Or accrued revenue, where we've done the work, and we just haven't billed our clients yet. So the revenue's accrued, but we haven't created the accounting process that goes with it. And then the last category, which is coming soon, I promise, which is its own special snowflake, which is called depreciation. And additional entries could be caught along the way. Maybe we find a mistake, and Uncle Sam, in the accounting process, we're paying our taxes and we need to make sure our books are correct. And we find through some close examine that we've missed something. So let's take a look at another example here. So in the continuing Luca's Lemonade example, Luca's Lemonade has picked up an accrued expense that hasn't yet been accounted for. It needs to be accounted for. So we need some adjusting entries. So it turns out that Luca's Lemonade took loans and paid interest, but the interest payments have not yet been recorded on the books. You borrow money from a bank. The bank says, hey, you need to pay me interest for the privilege of using our money, the bank's money. Those interest payments that Luca's Lemonade has accrued have not yet been recorded through journal entries, so we need to take care of that. So here's what was going on. Here's back to the original Luca's Lemonade bank loan transaction. So on December 1, Luca had cash coming in for $10,000 because they took a loan payable for $10,000. On January 5, Luca's Lemonade had cash coming in, which is why it's debited for $25,000, and it picked up a loan payable. And cash came in, and loan payable became the account that was credited. Cash came in, loan payable became the account that was credited. Way back in the original journal entries that we did to keep track of this. So these adjusting entries are required to pick up this interest expense, which is considered an accrued expense. It's been building, it's been snowballing in the background. We need to make accounting records of it, and we use a journal entry to make those accounting records. So here's the story. Follow the red rectangle. As part of the bookkeeping review process at the trial balance unadjusted stage of the accounting cycle for Luca's Lemonade, so the trial balance unadjusted was done, and the review found that something was missed. So it was identified that the payment of interest on the 2 bank loans have not been recorded. The bank statement shows that the payments were made on time, so cash went out as anticipated to the bank, but the journal entries weren't recorded. These transactions need to be recorded so that Luca's Lemonade's books are accurate. Okay, we see the task ahead of us. We got to make some journal entries. So these Luca's Lemonade transactions, this accrued expense spans December 1, which was when that first loan was taken out, all the way through to the end of February. So imagine we're at the very end of February, looking back over the 3-month period, and 3 months in accounting terms is considered a quarter. It's a quarter of the year. So we're closing out the books at the end of a quarter, and we're about to start a new quarter. So that's us spanning different accounting periods. So we're looking back over that 3-month period. And here's our original journal entry. So December 1, January 5, cash came in, loan payable was our credit. And so here's the 3-month overview. So follow the red rectangle. So on December 1, the December 1 loan for $10,000 had $25 of interest payments paid on both, let me take it back, January 1 and February 1. So the loan was taken on December 1. On January 1, a month later, interest was due. On February 1, 2 months later, interest was due. The January 5 loan for $25,000 had a $62.50 in interest payments on February 5. It was originated on January 5, so a month later, the bank said, hey, give us some money, $62.50, please, which is your interest payment. These collective 3, January 1, February 1, February 5 interest payments need to be added onto the books for Luca's Lemonade. And then the question is, what will those journal transactions look like? We need to make some adjusting journal entries as part of the adjusting process. So we've got a $25 payment and a $62.50 payment. I'm pointing out these numbers because they're going to feature for us. The 25 payment happens twice for January 1 and on February 1. And the $62.50 payment happens once on February 5. So we're going to need to see two $25 payments and one $62.50 payments. And the date series we're looking at is going to be January 1, February 5. We need some journal entries. What are they going to look like? So these are adjusting entries, right? We're doing additional entries, the adjusting entries. So follow the red rectangle. So we need 3 dates. We need January 1, February 1, and February 5. Got them. Our interest payment involves cash going out. And if cash is going out, if we think back to our journal worksheet and the DCA grid, cash going out is considered a credit. So in each of these interest payments, the credit account is going to be cash. The debit offset, right, the balance to the cash is going to be a new account called interest expense. We haven't used interest expense yet. This is a new account that's going to enter itself into the chart of accounts for Luca's Lemonade. So January 1, February 5, cash goes out, interest expense is our new debit account. Over here to where the money happens, we've got debit for 25 and credit for 25. Related to January 1. For February 1, we've got debit for 25 and credit for 25. Now, a couple of things to point out. Debits and credits. Debits on the left, credits on the right. Does $25 balance with $25? 25 debit balances with 25 credit. Balance of 25 in February 1 balances with the credit of $25 in February 1. And February 5, which is where we were adding that new payment for that second loan, we've got a $62.50 debit. Does that balance with the $62.50 credit? Yes, it does. Debit's on the left, credit's on the right. Does it balance? Yes, it does. Go forward. Okay, $25, $25, 25, 25, 62.50, 62.50. We've got our $3 values entered. We've got our cash credited. We've got interest expense debited. We're making progress. We're all ready to move forward. Now, turns out since we found this after the fact, remember we were at the end of the 3-month period, looking back, and we found at the trial balance stage that we'd overlooked this whole accrued interest expense. Now we need to make some other adjustments to other things that we've already done. We just did the journal entry adjustments. We'd also have to go back to the T accounts, and we would have to adjust the cash T account to show the cash coming out, $25 once, $25 twice, $62.50 once. And then we would need to add a brand new T account for interest expense and go $25, $25, $62.50. We'd have to show that in the T accounts. We would also have to go to the general ledger and we'd have to update the entries for under the cash account in the general ledger, which makes sense because we updated the cash account and the T accounts. We would in the general ledger have to add interest expense as a whole new account and show our entries of $25 twice and $62.50 once. There's a lot of work going on here. And the point is, this was all caught at the original trial balance stage. We still need to go through the process of posting these adjusting entries and creating what's called an adjusted trial balance that will accommodate and absorb and show and ultimately reflect all of these adjustments that we've been making along the way. So trial balance unadjusted started, seems like forever ago. We've been focusing on adjusting entries. And eventually we're going to create a brand new trial balance called an adjusted trial balance that will reflect the work that we've been doing. But we're not there yet. There's still more to come. This is a busy segment. So we get here, this example just showed when we had caught a mistake and needed to make an adjustment. There's other reasons why we need to make adjusting entries. So a quick recap. Adjusting entry categories were expenses, things like prepaid expenses or accrued expenses. And common adjusting entries were under the prepaid expenses. We've done examples and there's video supporting examples related to prepaid rent. And there's a video that shows us the example of prepaid insurance. So it's a reflection of prepaid expenses as an adjusting entry category. Then we've now just done accrued expenses by doing a loan interest. We had accrued this loan interest expense, but we hadn't tracked it. We could do another whole process on wage expenses. We're not going to, but you can imagine that if we pay our employees every second week and every day we're accruing their wage expense, we're building a bucket full of money that we owe. So the same sort of concept could apply, and we could do a whole nother series. We're just not going to, but you can see how it all fits. And the last little special snowflake of these adjusting entries is called depreciation. And so we're going to spend some time, and yes, there's going to be another video that's designed to help us understand this depreciation category of adjusting entries. So hold on, there's still more to come. Adjusting entries constitutes a really large component of this accounting process. There's a lot of adjusting entries. There's a lot going on. Keep watching these videos, reinvest the time in understanding and following along what's going on. And the next video series related to adjusting entries is our special snowflake, all about depreciation. And so at this time, objective met, end of video.